Every time you swipe a card to pay for anything, a coffee, a tank of gas, a hotel room, a small percentage of that purchase disappears before it reaches the business you paid. It is built into the price before you ever see a bill for it, and you have been paying it your entire life without knowing it exists. This video is about where that money actually goes, and about a company that turned that quiet, invisible fee into one of the most powerful psychological weapons in the history of finance. Here is how far that weapon reaches. In 2015, a Chinese billionaire walked into Christie's auction house in New York and purchased a painting for $170 million. That number alone would have made headlines. But what this man did immediately after the hammer fell is the paw that sent every person in that room reaching for their phone to text somebody. He pulled out a credit card and handed it to the cashier. At Christie's, at the most elite art auction in the world, where fortunes change hands and old money meets new money, this man paid $170 million with a piece of plastic. And in doing so, he earned 132 million airline miles. That is enough for 100 round-trip first-class flights between London and New York. The card he used was matte black, heavier than any card you have ever held, and made from titanium. It has no credit limit because the company that issues it does not think in those terms. You cannot walk into a bank and apply for it. You cannot call a number and ask to be considered. The card is sent to you, uninvited, after the company has decided you are worth having. And the people who receive it, the Rockefellers and the Bezoses and the hedge fund managers who move between continents like you move between rooms. Those people have been known to turn down invitations to more than one just so they can say they were invited more than once. This is part of an ongoing investigation into the systems that quietly extract money from every transaction we make, whether we notice or not. If that's the kind of thing you want to understand, subscribe before we go further. This is the American Express Black Card, also known as the Centurion, and it is only the most dramatic expression of something that American Express has been building for 170 years. A company that started as a mail delivery business in upstate New York, that nearly went bankrupt twice, that survived world wars and financial panics and existential threats from billion-dollar competitors, and that has managed to do something that no other financial company on earth has accomplished at the same scale. It made wealthy people feel like membership in its network was a social distinction, not just a payment method, a signal. Anaiti, the story of how American Express got from a horse-drawn mail wagon in Buffalo, New York, to the titanium card of the global ultra-wealthy is a story about the manufacturing of trust. About how one company, at the exact moment when it had every legal right to walk away from a crisis, chose to stand and pay. And how that single choice, made in 1963, became the cornerstone of a brand worth more than $100 billion today. To understand what American Express built, you have to understand the problem it was originally built to solve. In the mid-1800s, moving money across long distances was one of the most dangerous and complicated problems that wealthy Americans faced. There were no wire transfers, no electronic payments, no international banking networks in any modern sense. If you were a wealthy businessman in New York who needed to purchase goods in Paris or London or San Francisco, you had essentially two options, and both of them were terrible. You could carry cash, which meant stuffing gold coins or paper money into your luggage and hoping that nobody between you and your destination noticed. Robbery on long journeys was not a minor risk. It was an industry. There were people who made a professional living identifying wealthy travelers, tracking their movements, and waiting for the right moment to separate them from their money. The safer the locking mechanism on your trunk, the more professional the thieves who tried to crack it. This is not a metaphor. Louis Vuitton became famous in the middle of the 19th century not primarily for style, but because it invented a lock that professional thieves at the time could not crack. The luxury luggage business was, at its core, a security technology business. Your second option was to carry a letter of credit from your bank, a document stating that the bearer was creditworthy and that a corresponding institution in Paris or London should extend them funds. This worked reasonably well in peacetime when the global banking system was functioning normally, and when the correspondent banks trusted each other. But the moment any disruption occurred, any financial panic, any war, any banking crisis, the letter of credit became worthless. The correspondent bank could simply refuse to honor it, and there was nothing you could do except stand at the counter and explain that you were very wealthy. Back home and wish that the man across the desk from you found that as impressive as he should. American Express was founded in 1850 as an express mail and freight company, a competitor to Wells Fargo, operating between Buffalo and New York. The founders were Henry Wells, William Fargo Burfield, the same men who would later found Wells Fargo. The early business was unglamorous, moving packages, delivering freight, acting as a courier service in the era before reliable postal systems. But as the company grew, it started handling financial instruments, moving money and documents for banks and businesses. And somewhere in the late 1880s, the president of American Express at the time, a man named James Fargo, who was the nephew of one of the founders, experienced firsthand how useless the existing solutions were for wealthy travelers. Fargo was a prominent man traveling to Europe, and he arrived in smaller towns to find that his letter of credit was essentially worthless there. Local banks would not honor it. He had to cable back to New York for emergency funds, which was humiliating and slow. He came back furious and told his employees to solve the problem. The solution they came up with was one of the most elegant financial innovations of the 19th century. They called it the traveler's check. The traveler's check worked on a mechanism of dual signatures that was brilliantly simple. You walked into an American Express office and paid $1,000 in cash. You received $1,000 worth of traveler's checks, which you signed in front of the Amex clerk at that moment. The clerk watched you sign. Those checks were now yours, and they were useless to anyone who did not have your signature. When you arrived in Paris and wanted to pay your hotel bill, you signed the same check a second time in front of the hotel's cashier, who compared both signatures. If they matched, the check was valid. The hotel accepted it, then brought it to the local American Express office and exchanged it for cash. Think about what this solved. If your luggage was robbed, the thieves had nothing. The checks were numbered, registered to you, and worthless without a matching signature. American Express would cancel the stolen checks and issue you new ones. Your money was effectively insured. For a wealthy traveler in 1890, this was not a minor convenience. It was a revolution. You could travel across the world with a piece of paper instead of a suitcase full of gold, and if anything went wrong, the company had your back. By 1910, American Express was selling approximately $32 million worth of travelers' checks annually. The business model had a feature that the company would not fully appreciate for many years: the money. When you bought $1,000 in travelers' checks, American Express held your $1,000. They invested it, earned returns on it, and paid you nothing for the privilege. This is called float. Every dollar sitting in the form of unredeemed travelers' checks was an interest-free loan from the customer to the company. As the travelers' check business grew, the float grew with it, and the float became one of the most quietly profitable elements of the American Express business. Then, in the summer of 1914, the world changed in 4 days. There's a decision buried in this story that most people who carry an Amex card have never heard about, the one that explains why this company still exists today. We'll get there. When World War I began in early August of 1914, it did not begin gradually. It began catastrophically. Austria-Hungary declared war on Serbia On July 28th, Germany declared war on Russia on August 1. Germany declared war on France on August 3rd. Britain declared war on Germany on August 4th. And in the space of 1 week, the entire European banking system seized up. Banks across the continent refused to honor foreign financial instruments. Letters of credit from American banks became worthless overnight. Foreign exchange markets stopped functioning. And approximately 150,000 American tourists and business people who happened to be in Europe at that moment found themselves stranded with money that was suddenly, practically, worth nothing. This was not a minor inconvenience. These were wealthy people, industrialists, socialites. The kind of Americans who crossed the Atlantic on first-class ocean liners because second class was beneath them. Men who owned mansions on Fifth Avenue could not buy a single meal in Paris. Men who owned fleets of yachts could not pay for a room at the hotels where they had been staying for weeks. The newspapers reported cases of millionaires sleeping on benches. One reportedly had to borrow small change just to get a shave. Every financial institution in Europe had made the same calculation simultaneously in a time of national crisis. The obligations to foreigners could wait. Every bank closed to foreign claims. Every promise evaporated, except one. American Express kept its offices open. This decision was not required by law. It was not required by their business agreements. The traveler's check said American Express would honor them, and American Express did, every day, through the early months of the war, paying out dollars to Americans who showed up at their offices carrying those small pieces of signed paper. And they went further. When Americans showed up, holding letters of credit from other banks, American banks, whose obligations American Express had no legal responsibility for whatsoever, they honored those too. They gave out money to stranded Americans who were not even their customers. The British government was so impressed by the American Express operation that they assigned Amex employees to help transfer funds in active war zones. American Express ran courier operations behind the lines, moving money to where it needed to go in the middle of a continent at war. The scale of what they did is captured in one number. Travelers' check sales went from $32 million in 1913 to $522 million in 1945. That increase is not explained by marketing. It is explained by word of mouth from people who had been in Europe when the banks closed and who spent the rest of their lives telling the story of the company that showed up when everyone else walked away. The lesson that American Express absorbed from World War I was simple: trust compounds. Every dollar they spent honoring obligations they were not legally required to honor came back multiplied. Because the people they helped told other people, and those people told other people. And the story accumulated into a reputation that was worth vastly more than any individual payout. American Express launched its first charge card in 1958, and from the beginning it was structurally different from every other financial product on the market. It was a charge card, not a credit card. The distinction matters. A credit card lets you carry a balance. You buy something today, you pay some of it next month, you pay interest on the rest. A charge card requires you to pay the full balance every month. There is no revolving debt. The implicit promise is, you can have access to this, but you have to be the kind of person who can afford to pay it off. The card filtered its own users. Within a few years, American Express cards were accepted at more than 85,000 establishments across the country. The company had achieved something remarkable. It had convinced millions of Americans that paying a membership fee, plus no credit line, was a better deal than a free credit card with a revolving balance. The brand was doing work that the financial terms alone could not justify. In 1966, Amex launched the Gold Card. In 1969, the Green Card. In 1984, the Platinum Card. Each was positioned as more exclusive than the last. The Platinum came with something new, a dedicated concierge service, available to cardholders 24 hours a day, 7 days a week, to handle whatever they needed. In 1984, this was remarkable. The internet did not exist. Travel booking meant calling a travel agent and waiting. Making a restaurant reservation at a popular New York restaurant could require calling weeks in advance and knowing somebody. The Platinum Concierge bypassed all of that. You called one number and described what you needed. They figured it out. But before the card hierarchy could be completed, American Express had a near-death experience, and the man who saved them was the most famous investor who ever lived. In the early 1960s, the United States government was running a program that subsidized the export of surplus agricultural commodities, including vegetable oil. The program created an opportunity, and a man named Anthony de Angelis saw it. De Angelis was a commodities trader, a big-talking hustler from New Jersey who had already been banned from the egg business for falsifying records. In the world of vegetable oil, he found a much larger canvas. De Angelis controlled a network of storage tanks in New Jersey, and he had a relationship with a subsidiary of American Express called American Express Warehousing. The warehousing subsidiary would inspect his tanks, certify how much oil they contained, and issue official receipts documenting the inventory. Those receipts, bearing the American Express name and official certification, were then used as collateral. De Angelis took them to 51 banks and brokerage firms and borrowed approximately $150 million against the certified inventory. The inventory did not exist. De Angelis had filled the enormous tanks with seawater, then floated a thin layer of vegetable oil on top. When the inspector arrived with his measuring rod, he dipped it into the tank, pulled it out, and saw it dripping with oil. He signed the receipt certifying the tank was full of oil. The tanks were full of seawater. De Angelis had also rigged a system of pipes connecting the tanks, so that when the inspector finished certifying Tank A and walked toward Tank B, De Angelis's workers pumped the oil from Tank A to Tank B through underground pipes. Every tank the inspector checked appeared full. Every receipt he signed was a lie. The fraud came apart in November 1963, the same week that John F. Kennedy was assassinated. The timing buried the story in the news cycle for days, but the financial damage was immediate. 51 financial institutions discovered they had lent $150 million against collateral that was mostly seawater. They all turned to the same place, the name on the official receipts, American Express. Technically, the legal situation was clear. American Express Warehousing had issued fraudulent receipts, but the parent company, American Express proper, was a separate entity. The banks had made imprudent loans without sufficient verification. American Express's lawyers advised that the company's legal exposure was limited. Howard Clark, the CEO, could have stood up and said, "We did not lend this money. We are not a bank. The fraud was committed by a rogue subsidiary. And we are not responsible for the lending decisions of 51 financial institutions who should have conducted their own due diligence." On November 27, 1963, Howard Clark stood up and said the opposite. He announced that American Express felt morally obligated to compensate the victims of the fraud, even though it was not legally required to do so. The company paid out $60 million. The stock fell more than 50%. Wall Street analysts called American Express effectively insolvent. Investment banks began writing reports about what would happen to the company in bankruptcy. And a 24-year-old investor in Omaha, Nebraska, started quietly buying everything he could. Warren Buffett invested approximately 40% of his partnership's entire assets in American Express at that moment. He went to restaurants and sat near the cashier and watched how many people paid with Amex cards. He talked to travelers about whether the salad oil scandal had changed how they felt about their membership. What he found was that wealthy Americans were not canceling their Amex cards. They were renewing them. Because what Clark's decision to pay had demonstrated was precisely the thing that Amex had been building since World War I. When things go wrong, American Express keeps its promises. Buffett understood that the $60 million payment was not a loss. It was an investment in the most durable asset a financial company can own, which is the unshakable belief of wealthy customers that the company will stand behind them. He held the stock for years, made approximately 20 times his investment, and never really stopped thinking of Amex as one of the best businesses he had ever encountered. Berkshire Hathaway today owns approximately 21% of American Express, making it one of the largest single shareholders in the company. To understand why American Express has been able to charge its way into the wallets of the wealthiest Americans while facing trillion-dollar competitors, you have to understand a structural decision the company made at the beginning that creates an almost impossible competitive advantage. Visa and MasterCard are not really card companies. They are infrastructure companies. The card you carry that says Visa on it was issued by your bank. The credit line on it comes from your bank. The customer service for it runs through your bank. When you have a dispute, you call your bank, not Visa. Visa sits in the middle of a four-party network connecting you, your bank, the merchant, and the merchant's bank, and takes a fee of about 2% on every transaction. This is an extraordinarily profitable business, but it has one fundamental limitation. Visa has no relationship with you. You are a number in a database. Visa knows nothing about your loyalty to them because you have no loyalty to them. You have loyalty, maybe, to your bank. American Express operates what is called a closed-loop system. Amex issues your card directly. Amex is your lender. Amex runs your customer service. Amex negotiates directly with the merchant who accepts your card. There is no bank in the middle. When you spend $10,000 at a hotel with your Amex Platinum, Amex sees every line item. They know which restaurants you preferred, which room category you selected, which amenities you used. They know, in aggregate, more about where wealthy Americans spend money than any other private company on earth. This data advantage compounds over time. American Express can look at a cardholder who has spent $50,000 over the past year and know exactly which categories they are most loyal in, which merchants they frequent, and where there is spending that could be shifted to Amex if the right offer were made. The company runs something called Amex Offers, a system that delivers targeted discounts and promotions to individual cardholders based on their specific spending patterns. A cardholder who regularly buys wine gets a different set of offers than one who regularly flies business class. The precision of the targeting is possible only because Amex owns the entire relationship. This structural advantage also lets Amex charge merchants more. While Visa and MasterCard take roughly 2% on transactions, Amex charges between 2.5 and 3.5%. For high-volume merchants, that difference compounds quickly. A restaurant doing $5 million a year in credit card sales pays Amex roughly $175,000 extra compared to what it would pay Visa. Many merchants have historically refused to accept Amex for exactly this reason, which created the long-standing reputation that Amex was not accepted everywhere. But Amex's counterargument to merchants has always been the same, and it is backed by real numbers. Amex cardholders spend more. The average Amex cardholder spends significantly more than the average Visa or MasterCard holder. BCAUSC, Amex, has consistently positioned itself at the upper end of the income spectrum. When Amex walks into a negotiation with a high-end hotel chain and says accept our card at our rates or your wealthiest guests will be annoyed, that threat has teeth. the luxury segments of the hospitality industry, the airlines, the rental car companies. The hotels that charge $600 a night cannot afford to tell their best customers that a payment method is unavailable. The feedback loop is self-reinforcing. Higher merchant fees generate revenue that funds better rewards. Better rewards attract wealthier cardholders. Wealthier cardholders generate more spending. More spending forces merchants to accept the card at the higher rate. And the cycle repeats, pulling more revenue and more premium customers into the network with each rotation. The card hierarchy that Amex constructed over the decades is a masterpiece of aspirational marketing. The green card established basic membership identity. The gold card was achievable with effort. The platinum, launched in 1984, was attainable by successful professionals and came with enough benefits to justify its annual fee. And the black card, when it arrived in 1999, was designed to be unreachable by conventional aspiration. You could not want it and work toward it. The only path to the black card was to spend enough on your platinum that Amex decided to invite you. The specific spending threshold has never been officially announced, but the generally understood number for new invitations has historically been around $250,000 to $500,000 in annual Amex spending. The Centurion Card costs $10,000 to initiate and carries an annual fee of $5,000. For this, you receive a titanium card, a dedicated personal relationship manager who knows your preferences and handles your needs. Access to every airport lounge in the Centurion network, companion business class tickets on certain airlines, hotel status upgrades, and the services of a concierge operation that has become legendary in the lore of extreme wealth. The concierge stories sound like invention until you understand that they are marketing by the cardholders themselves. A member who needed authentic sand from the Dead Sea for their child's school project called the concierge. And an agent was dispatched to Jordan, where Dead Sea sand was collected and shipped to the member's home in London. Another member wanted the specific horse that Kevin Costner had ridden in the 1990 film Dances with Wolves. Not a horse that looked like it, but the actual animal from the production. The concierge found the horse living at a ranch in Mexico, negotiated its purchase, and arranged the live transport across an ocean to deliver it to the member's property in Europe. These stories circulate because the people who receive this service tell them, and the people who tell them are doing something that Amex has always understood about wealthy human beings. They want proof of their own status that they can communicate to other wealthy human beings. The Centurion Card is a conversation starter, a proof of belonging, a piece of physical evidence that you are in the room where the serious decisions get made. No amount of advertising could manufacture that. Only the actual performance of the promise creates it. The 2008 financial crisis tested American Express in ways that were different from any previous test. The company was not primarily a mortgage lender. It was not holding toxic assets at the scale of Citigroup or Bank of America. But it was deeply exposed to consumer spending, and consumer spending collapsed. Charge-offs on outstanding balances rose sharply. The corporate card business, which was a massive revenue center, contracted as companies slashed travel budgets. Amex had built its identity around wealthy customers. But 2008 revealed that even wealthy customers reduce their spending when the economy enters a genuine depression-adjacent crisis. To access the emergency federal funding that became available through the Troubled Asset Relief Program, American Express applied to become a bank holding company in November 2008. The Federal Reserve approved the application in a matter of days. This was remarkable. American Express, which had spent its entire corporate life emphasizing that it was not a bank, that its products were different from bank products, that its relationship with customers was personal in ways that bank relationships were not. became a bank holding company to access $3.39 billion in federal bailout funds during the financial crisis. The company repaid the TARP funds with interest in June 2009, faster than most institutions that participated in the program. Seiyuken Shinobu Kazuan navigated the crisis with the same instinct toward institutional commitment that had defined Amex's best moments. Shino, who was the first black CEO of a Fortune 500 company of that scale, had also led American Express through September 11, 2001, when the company's headquarters in the World Financial Center was damaged and when the collapse of the World Trade Center towers destroyed the heart of American corporate travel. He responded to September 11th by immediately announcing that Amex would not lay off employees as a direct result of the attack, and he authorized the company to help stranded cardholders around the world get home. The precedent from World War I ran straight through the institutional DNA of the company. The most serious, competitive threat American Express has faced in the modern era did not come from Visa or MasterCard. It came from J.P. Morgan Chase in 2016 when Chase launched the Sapphire Reserve Card. Chase offered a $450 annual fee card with a $300 travel credit, priority pass airport lounge access, triple points on travel and dining, and a sign-on bonus of 100,000 points. The card was so well designed and the launch was so aggressive that Chase ran out of the metal stock used to manufacture the cards within days. Young, affluent professionals who had been considering Amex Platinum switched to Sapphire Reserve in numbers that were significant enough that American Express noticed immediately. The Sapphire Reserve threat exposed something important about the Amex model. The company had for decades been able to charge a premium for its brand identity without having to match competitors' point-for-point on product benefits, because there was no competitor offering a comparable product to the same customer segment. Chase changed that. Suddenly, a J.P. Morgan product was available with benefits that were at least comparable to Amex Platinum at a lower annual fee and without the perception of inaccessibility that came with the Amex brand. Amex responded by dramatically expanding the benefits of the Platinum card. The annual fee for the Amex Platinum today is $695, up from $450 before the competitive pressure intensified. But the benefits expanded dramatically alongside the fee, up to $200 in airline fee credits, up to $200 in hotel credits, $240 in digital entertainment credits, $155 in Walmart Plus membership credit, $100 in global entry or TSA pre-check credit, cell phone protection, purchase protection, return protection, and access to Centurion lounges that Amex has been building aggressively in major airports. The product is now explicitly premium in a way that requires ongoing justification. And the company has invested in the lounge network and the benefit structure to provide that justification. The Centurion lounges have become something of an arms race within the premium card industry. Amex has opened locations in New York, Los Angeles, Dallas, Seattle, San Francisco, Rongi-Kongi, and a growing list of international cities. They offer restaurant-quality food, full bars, spa services, showers, and the kind of staffing ratios that airport terminals typically reserve for no one. For frequent travelers who can fully utilize the benefits of the Platinum card, the annual fee can be justified almost entirely through the lounge access alone. For infrequent travelers who derive less value from the benefits, the fee is harder to justify. And Amex has learned to live with a churn cycle where some cardholders sign up for the welcome bonus and cancel before paying a second annual fee. What American Express is actually selling underneath the metal card and the lounge access and the concierge you will find Kevin Costner's horse is a very old product that has very little to do with payments. It is selling the feeling of being taken care of by an institution that has a long history of taking care of people when no one else would. It is selling the World War I story. It is selling the moment when Howard Clark stood up and paid $60 million for a fraud he did not commit because the alternative was to be a company that walked away from its promises. The business is structured to make wealthy people feel like their membership in the Amex network is special in ways that no amount of Visa marketing can replicate. Because Visa and MasterCard are infrastructure companies and American Express is something different. It is a membership organization that happens to process payments. The annual fee is the dues. The benefits are the programming. And the brand is the culture that makes paying $695 a year to be a member feel not just acceptable but desirable. What Buffett saw in 1963 when he watched people pay their restaurant bills with Amex cards, while the salad oil scandal was in every newspaper, was something he has described in various forms over the decades. American Express had built something that lived in the minds of its customers in a way that competitors could not easily duplicate. The company's share of wallet in the upscale segment was not primarily held by product features. It was held by reputation accumulated over more than a century of institutional behavior. There is a line that runs from James Fargo coming home furious about his worthless letter of credit in 1888, to the traveler's check that solved the problem, to the American offices staying open in August 1914 when every bank in Europe closed, to Howard Clark paying $60 million in 1963, to the Centurion concierge finding a horse in Mexico in the 2000s, to the Amex Platinum card that sits in the wallets of several million people today. That line is trust. And the people who have held that line have understood something that most companies get wrong. Trust is not built in marketing campaigns. It is built in the moments when it would be convenient not to keep your promise. American Express is valued today at more than $200 billion. It is one of the largest financial services companies in the world by market capitalization. It processes trillions of dollars in transactions annually. Its brand is recognized in virtually every country on Earth. And its business model, the closed-loop system that owns the entire relationship with the cardholder, gives it a structural advantage over competitors that spend enormous resources trying to replicate the same customer knowledge and loyalty. The Chinese billionaire who pulled out his black card at Christie's was doing several things simultaneously. He was paying for a painting. He was earning a staggering number of airline miles. He was telling everyone in that room something about who he was and how he moved through the world. And he was participating in a brand mythology that a mail courier company in Buffalo, New York, built by accident in the 1850s and then deliberately turned into one of the most durable competitive advantages in American corporate history. The black card weighs more than any credit card you have ever held. It is heavier because it is made from titanium, and it is worth more than any card you have ever held, not because of the metal, but because of everything the company spent 170 years building to make that card mean what it means. That meaning cannot be manufactured in a marketing meeting. It can only be earned by keeping promises when it is expensive to do so. American Express keeps doing that. And as long as it does, the card stays black. What the numbers reveal about how American Express actually makes money is different from what most people assume. The common assumption is that credit card companies make most of their money on interest. The 20 or 25% annual interest rate that gets charged when people carry balances. And for most credit card issuers, that assumption is basically correct. Capital One, Synchrony, Discover, these are fundamentally lending businesses that use the card as a distribution channel. American Express is fundamentally a different business. The company makes the majority of its revenue from what it calls discount revenue, which is the technical term for the fee it charges merchants on every transaction. The card-carrying member is not primarily the customer that Amex is extracting money from in the way that a traditional bank extracts interest from credit card holders. The merchant is. Every time you swipe your Amex card at a restaurant or a hotel or an airline, the merchant pays Amex roughly 2.5 to 3.5 cents on every dollar of that transaction, multiplied across trillions of dollars in annual transaction volume that adds up to the majority of the company's revenue. This distinction matters for understanding what Amex actually cares about, because Amex makes money primarily from transactions, not from interest. It wants its cardholders to spend as much as possible, and it wants as many merchants as possible to accept its card. The rewards programs, the benefits, the concierge service, the lounge access, all of these exist primarily to drive spending volume, because more spending volume means more merchant fees. American Express spent decades charging premium annual fees that seemed almost impossibly high for a payment card, and using the revenue from those fees to fund benefits that drove cardholders to spend more on the card. The math worked because the incremental merchant fees generated by higher spending more than covered the cost of the benefits. The co-brand partnership model extends this logic. American Express partners with Delta Air Lines, Hilton Hotels, Marriott, and dozens of other major brands to issue co-branded cards that carry both the Amex and the partner brand's identity. The Delta SkyMiles American Express card is the most significant of these relationships. Delta sells miles to American Express, and Amex in turn awards those miles to cardholders for their spending. Delta benefits because it gets cash from Amex upfront for miles that may never be redeemed at full value. Amex benefits because Delta loyal customers who want to accumulate miles have a strong incentive to concentrate their spending on an Amex card. The partnership creates a loyalty lock-in that neither company could achieve alone. The scale of these co-brand relationships is staggering. Delta receives billions of dollars annually from American Express through the SkyMiles partnership, a figure that has at certain points exceeded the airline's core operating income. American Express, in return, gets access to Delta's most valuable customer segment, the frequent business traveler who spends six figures a year on airfare and expects nothing less than premium service. The Delta Amex Platinum card carries a $350 annual fee. The Delta Amex Reserve card carries a $650 annual fee, and both are sold to customers who are already deeply embedded in Delta's loyalty ecosystem. These are not customers who chose an Amex card because they needed a payment method. They chose it because the combination of Amex service standards and Delta miles is specifically valuable to the life they lead. Corporate cards represent another dimension of American Express dominance that rarely gets mentioned in the consumer-focused coverage of the brand. The Amex, Business Platinum, and Business Gold cards are not just personal card equivalents with a slightly different name. They are the foundational product for how many medium and large companies manage their employee travel and expense programs. Companies with significant travel budgets find that centralizing spend on corporate Amex cards provides reporting infrastructure, negotiated rates with hotels and airlines, and the kind of expense tracking that finance departments require. American Express has built an entire software and services ecosystem around corporate card management that creates switching costs far higher than anything a consumer card can generate. A large corporation that has integrated Amex into its expense management system, its accounting software, its travel booking platform, and its reimbursement workflows does not switch payment networks because Chase offered a better rewards rate on dining. This is the quiet power of American Express in the corporate world. When a Fortune 5 sends its executives to conferences in Tokyo and Singapore and London, those executives are almost certainly traveling with Amex cards. The corporate card business generates volume that no individual consumer can match. and it generates the kind of institutional loyalty that compounds over decades. Finance departments are conservative. Once a vendor is embedded in the core workflow of a large organization, the effort required to replace it typically exceeds whatever marginal benefit a competitor can offer. American Express has been embedded in corporate America's expense management infrastructure for so long that for many companies, it is functionally invisible in the same way that electricity is invisible. You notice it only if it stops working. The Centurion Lounge expansion that Amex has undertaken over the past decade is the physical manifestation of the premium bet the company has made. Building and operating airport lounges is expensive. Premium food service, premium staffing, premium design, premium location within the airport terminal, all of it costs money. And the investment only makes sense if the lounge increases cardholder spending and retention at rates that justify the capital cost. The evidence suggests it does. Cardholder surveys consistently show that airport lounge access is among the highest valued benefits associated with premium travel cards. And Amex has used the Centurion brand to differentiate its lounge experience from the Priority Pass network that other cards provide access to. Priority Pass is a third-party network available to many competing cards. Centurion lounges are exclusively Amex, available only to Platinum and Centurion cardholders. That exclusivity is the product. Ken Shino's leadership of American Express from 2001 to 2018 is worth understanding as a case study in institutional stewardship. He inherited the company in good shape, then watched September 11th destroy the corporate travel market within days of his formal start as CEO. His response was to increase Amex's investment in the affected communities while competitors pulled back, to maintain the company's commitments to employees, and to press forward with the premium positioning strategy rather than retreating toward mass-market products. Under Shino, American Express significantly expanded its international footprint, built out the co-brand partnership model, and navigated both the 2001 recession and the 2008 financial crisis without permanently damaging the brand's premium positioning. Shino became the first black chief executive of a company of that scale in American corporate history, and he held the position for 17 years. His tenure is considered one of the more successful long-term stewardships of an iconic American brand. The company he handed to Stephen Squeri in 2018 was one that had held its premium positioning through a period of intense competitive pressure and was beginning to see the benefits of significant investments in millennial and younger affluent consumers. The strategy of reaching customers at the beginning of their careers, when their spending is still relatively modest but their trajectory is clearly upward, gives Amex decades of potential relationship duration. The Amex Gold Card, repositioned with a significant restaurant benefit and a lower price point than the Platinum, became the card of choice for young professionals in urban markets who spend heavily on dining and who aspire to the Platinum tier. The company is betting that today's Gold cardholder, who spends $30,000 a year on restaurants and travel, will be a Platinum cardholder 10 years from now when their income and their spending have grown to match the product. The psychology of what the annual fee actually buys is worth examining more carefully than most financial analysis does. Conventional thinking about credit card economics focuses on the rational calculation. Does the value of the benefits exceed the cost of the fee? If the $695 annual fee for an Amex Platinum can be offset by $200 in airline credits, $200 in hotel credits, $240 in digital entertainment credits, and various other statement credits, then a cardholder who uses all of those benefits is effectively paying zero for a card that also gives them lounge access, travel insurance, purchase protection, and the status of holding a premium metal card. But the rational calculation misses what American Express has always understood about wealthy customers. They are not primarily motivated by rational calculations about cents per point and annual fee amortization. They are motivated by how they feel. The Amex brand makes people feel like they are in a category that not everyone can access. And that feeling is worth more to them than any specific benefit. This is why Amex can charge $695 for the Platinum and $5,000 for the Centurion and find takers for both. Even when the mathematical case for either requires generous assumptions about benefit utilization. It is also why the concierge stories matter so much strategically. American Express does not advertise the story about the Dead Sea Sand or the Kevin Costner horse. Cardholders tell those stories themselves, spontaneously, in contexts where the audience is impressed and the teller enjoys the impression they are making. Every time a Centurion cardholder tells one of those stories, at a dinner party or a board meeting or a charity fundraiser, they are doing unpaid marketing for American Express that no advertising agency could produce. The stories work because they are true and because the audience for those stories is composed of people who file away the information that a specific card can do specific things that money alone cannot arrange. American Express has spent 170 years learning that the people with the most money are the most sensitive to signals of belonging. They already have everything that money can buy. What they cannot simply purchase is the feeling of being in a group that is genuinely exclusive, that has real standards and real membership requirements, that does not let just anyone in. The Centurion Card creates that feeling more effectively than almost anything else in the financial industry, because the restriction on access is real. You are not chosen because you have a good credit score. You are chosen because you have spent enough, consistently enough, on your existing Amex card that the company has decided you are worth the invitation. That distinction feels different from applying and being approved. It feels like recognition. The company has navigated enormous changes in how payments work and will continue to face challenges as digital wallets, by Dash Now, Dash Pay, Dash Later services, and cryptocurrency create new ways for wealthy consumers to transact outside the traditional card network. But American Express has a specific asset that none of those technologies can easily replicate. 170 years of institutional behavior that has consistently prioritized keeping promises over short-term financial optimization. The traveler's check that honored obligations during World War I, the CEO who stood up in 1963 and paid $60 million for fraud he did not commit. The concierge who found a horse in Mexico and shipped it to Europe because a member asked. None of those decisions were economically optimal in the moment they were made. All of them were the right decisions for the long-term health of the brand, because they accumulated into a reputation that is now one of the most durable competitive assets in American business. Buffett recognized this in 1963 when he put 40% of his partnership into a company that Wall Street had declared was going bankrupt. He recognized it in the way that he has always recognized great businesses, by looking past the quarterly numbers to the thing that would still be true about this company in 20 years. American Express is still true. The card in your wallet, if you have one, connects you to a story that started in Buffalo in 1850 and has never stopped accumulating. And the black card, the matte titanium invitation that arrives uninvited at the homes of people who spend enough to warrant the attention, is not really a payment method. It is a receipt for something purchased a very long time ago, by a company that decided its word was worth keeping, even when keeping it was expensive.